Hello, everyone, and welcome to this latest episode of the Bull and the Bear podcast. I'm your host and moneyandmarkets.com research analyst, Matt Clark. Glad you're with us again to end the week. Been an interesting week on Wall Street. We'll talk about that in other venues. But first, I want to kind of clear things, get the housekeeping stuff aside. If you are watching this on YouTube, would encourage you to check us out as a podcast. You can do so by going and following us on Apple Podcasts, Google Podcasts. We're also on Spotify, iHeartRadio, and we're working on getting on Amazon, which means you'll be able to use your Alexa-connected devices and speakers to listen to us. If you do that, make sure you do follow us, do subscribe to the podcast, and if there is an option to be alerted when we release a new podcast, I would highly encourage you to do so. Just simply because we usually put the podcast up before we put them on our Money and Markets website, so you kind of get an insider take. You get that information before anyone else does. So it's a good idea. We don't usually bog you down with a ton of notifications and things like that. So it's a good idea. Conversely, if you are listening to us on one of those podcast channels and you want to see a video of the podcast, we can do that. We do that as well. You can just go to youtube.com and type in Money and Markets. You'll find our green logo there. Same thing applies. Hit subscribe, and I think there's a little bell that comes up, and if you click that bell, you can get notified every time we release a new video. Not only the Bull and the Bear, but our Money and Markets week ahead, as well as the marijuana market update, and anything else that any other videos that we produce, you can get alerted right away. And usually, again, they come out on YouTube before they come out on our website. So it's kind of an insider thing. If you have a comment, question, anything like that, make sure, by the way, leave a review on either podcast or on YouTube, or a comment on either of those. We'd love to see your feedback. But if you do have a particular comment or maybe a question or a particular sector or stock you'd like us to look at, this is wildly popular with our marijuana market update viewers. So we encourage you to do the same. You can email us. It's thebullandbear@moneyandmarkets.com. Thebullandbear@moneyandmarkets.com will get that feedback to us. We'd love to hear what you have to think and have to say. And it's always great to get feedback. Always like to hear what readers and viewers have to say. Also, check out moneymarkets.com every day, putting up new safe and profitable investment information for you up on that website. So to jump right in, here in a bit, I will bring in Money and Markets Chief Investment Strategist Adam O'Dell, as well as contributor Charles Sizemore. But to kind of lead into what we're going to talk about today, this sector has been all the rage, and has been all the rage for quite some time. And it's powered at least one index to all-time highs, and that it was even during a coronavirus crash back in March. But the biggest issue here, the biggest thing that is going around in investors' minds and analysts' minds is, does that surge, is it sustainable? And of course, what I'm talking about is technology stocks, and this has been the buoy to the market, especially during the coronavirus crash and even before. Valuations are continuing to skyrocket across the market, even as the economy falters because of the coronavirus pandemic, lockdowns around the world. We've even seen data that the economy in European economy is starting to slip significantly. And so it's just interesting that if you look at the S&P 500 Technology Sector ETF, it trades as XLK. It's an exchange-traded fund that tracks some of the biggest tech stocks. It's jumped 64% since reaching a low in March of 2020. It covers companies like Apple, Microsoft, NVIDIA, PayPal Holdings. It has a very broad range of tech stocks. It's got a 50-day moving average. It's actually $13 above its 200-day moving average. Its one-year gains are 45.5%. That outpaces the S&P's gains of 16.8%. So it's actually pretty massive in terms of the growth of technology stocks of late. So, to jump right in, I'll bring in both Adam and Charles here, and I want to talk about three very well-known tech stocks that everyone has probably either heard of or used or maybe even being invested in. And I'll first start off with a company it's a software company. It's noted for its suite of products for video and photo content, software used by content creators, web application developers, digital media professionals. It also has expanded its offerings to digital advertising and marketing. That includes analytics, social marketing, targeting, and audience management. It has a creative cloud platform that allows users to download its creative products at will. I actually use Creative Cloud as full disclosure to help edit and produce this podcast. So the company I'm speaking about is Adobe Inc. It trades on the Nasdaq as ADBE. That's A, and then D as in dog, B as in boy, and then E, and that is Adobe. Adobe Inc. So first off, I'll send it over to Charles Sizemore, our Money Markets contributor, and get his thoughts on Adobe. So what do you think about this photo and video software platform company?
See, I like Adobe, and it's because Adobe is really a poster child for a traditional software company. It seems like a funny comment, a traditional software company, because software as an industry really isn't that old. But software transitioned from a product to a service. It wasn't that long ago that we bought software on a shrink wrap CD, and of course, then you downloaded it. But it was a one-time purchase. You might upgrade it once every couple of years, and it was a very lumpy revenue stream for the software developer. Well, Microsoft was one of the first large companies to switch to a software as a subscription model, and Adobe was not far behind them. In fact, I may be misremembering. Adobe may have actually done it before Microsoft, but I know both were very early to that trend. So the attractiveness of the subscription model is your cash flows become recurring, rather than this be, hey, I make one purchase today and then I may just stretch that out. I mean, how many of us had a version of Windows for like 6 years because you just didn't want to upgrade, right? Or a version of Office for 6. I actually got a Word document from Adam a few years ago that was like the version of Office from like 2007 or something crazy, and I gave him a hard time about that. But that's how the old shrink wrapped not shrink wrapped's the wrong word, but that's how the old software as a product model worked. The software as a service model, it's recurring revenue. It hits your credit card once every month, once every year, whatever, but it's recurring. That matters because when companies hit hard times, like today, for example, we're still in a recession, companies are less likely to put off software purchases when it's just an auto pay decision, when you're just doing this on autopilot. You can't really cut it, right? So I like Adobe a lot. I wouldn't mind if it was a little bit cheaper. It's not. It is an expensive stock. It's expensive relative to its own history here, but so is everything right now, frankly. So I'd say in this market, Adobe's good.
Okay, and Chief Investment Strategist Adam O'Dell. First off, welcome. Thanks for joining us. And what are your thoughts on Adobe?
Yeah, I like Adobe as well. I also use Adobe products. I kind of do photography in a little bit of free time that I have. So I use Lightroom, which is a photo management system, and also Photoshop, which is for editing. So I certainly enjoy their software, and it's very intuitive to use, very powerful. I like that, as Charles mentioned, it did move over to a subscription model. All of it's cloud-based, so you can kind of seamlessly use. I have Lightroom on my phone and on my computer, and whether I'm editing photos on either one, they sync together. So it's a seamless product. One of the things I like about Adobe is that they have more recently shifted at least one of their divisions to digital marketing, so helping people market on Instagram and Facebook and on the web. And obviously, digital marketing is a pervasive industry. It really, whether you have a brick and mortar store, you still want a digital market. If you're totally e-commerce, you're obviously going to be digitally marketing. So, the fact that Adobe has moved into that arena and has a foothold there, I think is great for powering double-digit growth ahead. The other thing I like about Adobe is that Warren Buffett talks about buying into companies that have a moat, that have a competitive advantage where they have a significant market share, and it's highly unlikely or very cost intensive for a competitor to come along and do what this company is doing. And I think Adobe definitely has that. I don't know of many other companies that are doing what Adobe does with the same level of expertise and mastery of the product and a foothold in as far as market share. So I think Adobe definitely has that moat where they're going to be kind of the top dog in this type of space for years to come. The great thing about Adobe is, and Buffett talks about this as well, is that they're price makers. So whereas commodity companies, I've talked about this when I recommend gold stocks. I'm high on gold stocks right now because the price of gold and precious metals is going up. But in the lean years, like after gold prices crashed from basically 2011 through this past year or so, they couldn't set their own price. If you were selling gold, you had to take the market price of gold, and you had to figure out how to cut costs low enough to survive. And most of the gold stocks that I've been recommending have done that. And now they're really earning fatter profit margins. But basically, commodity companies are price takers. They have to take the market price. Whereas a software company like Adobe, they can set their own price. If they realize that there's not another competitor out there doing what they're doing, and if they think that if the market will bear a price increase, then they can increase their prices pretty much as they want. And they obviously do this judiciously. They want volume as well. But that's one thing I like about Adobe, is that they're price makers. They can set their own price. They have a moat around their business. And as Charles said, they are rather overvalued right now. On my green zone stock ranking model, they rate 6 out of 100 on valuation. So they're not a cheaply priced stock right now. They're also a very large stock, so you're not going to get the typical small cap type of gains out of an Adobe. But otherwise, it rates very, very well overall. It has an 83 out of 100 score on my green zone model. And I definitely would be a buyer of Adobe. I'd certainly try to wait for a pullback if you want to be patient, but I think Adobe is a great name that'll be around for years to come.
And I agree with both of you. Its return-ons are strong. Its gross margins are great. Its net margin is fantastic, especially against the industry. Its sales are great. We talked about how it's software as a service, and that is just recurring income for them. I like they have discounts for education for students and teachers, which I think is phenomenal. So it's not just one of those things where they try to give back a little bit. They've got a very broad array of products out there, whether it be for photo or video. They even have app development software out there that you can download and help actually build your own app to then put on an app store. I really like Adobe. I think it's got its momentum is strong. It's been up for as I'm looking, it's been up over the last several days and continues to come off of its March low strong. I like where Adobe's positioned. I think it's definitely a buy for me. Moving on to our second company. This is a company that manufactures and sells internet protocol-based networking products. I know that's a very convoluted way of saying they basically just make your routers and your switches for both wired and wireless internet connections. They also produce products for internet security. This includes for network, cloud, and email servers. So if your company has an internal email server, this company may be one who's provided the internal security for that that server, so as it makes it very difficult to hack into it. It was founded in 1984. It's based in San Jose, California. This company is Cisco Systems Incorporated, trades on the Nasdaq, CSCO. That's CSCO, Cisco Systems. And I'll start with Charles. Charles, give me your take on Cisco.
I'd probably take a pass on Cisco. It'll be around. This is not a company that's going anywhere, but it ties back to what Adam was saying about commodity companies. And I know this is not a gold miner. They're not digging things out of the ground, but tech hardware effectively is a commoditized product these days. It's not hard for a cheaper competitor to do a lot of what Cisco does. That doesn't give them a lot of pricing power. At the end of the day, a lot of their tech is old tech. This is a 1990s tech stock, and their core business hasn't really changed all that much. It is relatively cheap. It pays a decent dividend. I think you could do worse than buying Cisco. I don't see a reason for it to outperform over the next year. To me, this seems like a middling stock that's just going to give you middling returns.
Okay, and Adam, what do you think about Cisco?
I'm also a pass on Cisco. It rates overall in my 6-factor model as a 54 out of 100, so right smack in the middle average. It's a large company, as Charles said. It's not going away. It's a decent value. It has a quality book. But as far as growth metrics and momentum metrics and volatility metrics, it's very just average, middle of the road. One thing I thought was interesting looking at Cisco's chart was that where most stocks were making new highs in the early 2020 prior to the middle part of February when we started catching on to the coronavirus, Cisco really topped out in like in like the summer of 2019. took a really, steep decline in the latter part of 2019 and early part of 2020. So it was trading well below its 200-day moving average. It was in a downtrend as coronavirus came on. So it obviously took another hit during the coronavirus, and it's kind of now trading back up to around where it was before the coronavirus. But again, it's still well off its high since it made a much higher high in 2019. So this tells me that the market's kind of shifted its attention elsewhere. It's looking at other, like Charles said, maybe looking away from the hardware manufacturers, which is a commoditized business, to more of the software makers or other portions of tech, maybe fintech. But yeah, for right now, Cisco's not going anywhere. I think that as 5G ramps up, and we'll see if it can get a good piece of that business. But right now, Cisco is just so for me. There's really no compelling reason to buy it, either technical or fundamental.
And I agree. I'll pass here. What I found interesting, you talk about looking at Cisco's chart, and I'm actually looking at it right now over here. And back in July, it actually had a golden cross where the 50-day moving average crossed above the 200-day moving average. But the only thing is that normally you expect some sort of a short-term rally at that point for the stock to go up. Cisco really didn't. And in fact, in just a very short amount of time, it's actually dropped back down. So, obviously the golden cross is not an absolute predictor of whether a stock is going to go up short-term or not. It's one of those that you kind of want to look at to see if a stock should move, a stock should move forward. And Cisco really didn't. And I think Adam's right. I think the market has shifted away from Cisco and is moving on to different things. So I too am a pass. I think, value-wise, it's not bad, but there's just nothing here that is screaming, growth and gains for investors anytime soon. So, maybe a buy and hold, but I just think in terms of right now, it's just not where it needs to be for me to get excited about it. Our third and final company, this is an interesting one, and I chose it for a reason. I'm just very curious to hear what Adam and Charles have to say about it. It specializes in cloud infrastructure for businesses and individuals. Basically, they offer cloud products and they offer cloud space. They have a cloud software applications that they provide. They're not necessarily more known for their cloud space as opposed to their cloud software. Cloud space is more Amazon or Google or Box or Dropbox or something like that. This company provides kind of that back-end infrastructure for those cloud services to be operational. It serves performance management, supply chain management, customer experience, human resources, places like that. But what made this company interesting is that just this past week, the company was backed by President Donald Trump to purchase Chinese social media app TikTok, and that was preferential over Microsoft or Twitter or anyone else. So this company has received that kind of that nudge from the president on where as far as buying a social media company that could soon very well be outlawed in the United States. Of note, the company did hit a golden cross back in June of 2020, where its 50-day average crossed above its 200-day average. For whatever you take that for, just toss out there. It was founded in 1977, based in Redwood City, California. It is Oracle Corporation, trades on the New York Stock Exchange under ORCL, so Oracle Corp. And Charles, politics aside, what are your thoughts on Oracle?
It's funny. Oracle brings back memories for me. Earlier part of my career, I was like a risk manager quant guy, and I used to play around on Oracle databases all day. And so it's funny. It's a good memory for me. But when I look at it, I see a company with a very murky competitive environment, and I know that's their database products are fantastic, but now that they're more of a cloud services company, they're up against two first move. Well, you can't have two first movers. But the first mover, Amazon Web Services, and the nipping at its heels second mover in Microsoft's Azure. So this is they have word, and they had Larry Ellison interviewed about the competitive threats that Oracle faces, and it's funny. He was extremely dismissive of some companies. He looked at IBM and he just kind of laughed. He's like, they used to be a competitor. They're nothing now. But then they asked him about Amazon and Microsoft, and he got real serious. He said, "Yeah, they're legitimate. They're legitimate competitors for us." So more broadly, I look at the TikTok deal, and I just kind of scratch my head. I don't really know what an enterprise cloud and database company is going to do with a consumer toy like that. That just seems like that would be destined to fail. Nobody at Oracle would have experience running something like that. So it would have to be just like almost like a passive portfolio company. Like Berkshire Hathaway is first and foremost an insurance company at this point, but they have all of these operating businesses that have nothing to do with insurance, right? But what happens is Buffett leaves the management team in place and he says, you guys run this. It's fine. Like, this is just we own you, but you guys do your own thing. We're not going to meddle. You'd have to do something like that if you're Oracle, and really Microsoft as well. Microsoft is one of the other contenders for TikTok. You look at that and like, these are not companies that would know how to manage that. Perhaps Facebook can manage it. Perhaps Twitter can manage it. I don't know that Twitter can even manage itself, let alone something new, but at least these are consumer facing social media companies, right? So I look at that and I say, if you're looking at buying Oracle because you think the TikTok thing will go through, don't. Even if Oracle somehow manages to buy TikTok, it's probably not going to be successful for them because they have no experience running it. So at any rate, would I buy Oracle today? Probably not. I think it's a good company. It'll be around for a long time. I don't see a compelling reason to buy it today.
And yeah, that's one of the main reasons why I brought it up, was because of the TikTok thing and how strange that marriage would be, just because you've got a cloud company and a social media company. The two have absolutely no connection at all, really. I mean, I guess you can trace back and find maybe some fifth level or sixth level type of a connection, but on the front, they're just, it just doesn't make any sense.
Matt, it's all computers. It's just all computer stuff.
Yeah, exactly. Which it is not. But Adam, what are your thoughts on Oracle?
I have a mixed take on Oracle. It rates fairly well in my 6-factor model of 72 out of 100, so pretty well, but not in top echelon. It gets high scores on quality, high scores on being a low volatility stock, and high scores on momentum. But it is a huge stock. It's just a mediocre value as far as I see it, and its growth is about 60 out of 100. So it's not really a high growth company. One thing that Oracle has going for it is that it operates in this space where, data, nowadays there's so much more data being created in the world, more data being collected, more data being used. That's really, in my opinion, the main source of a competitive advantage for any company, whether it's a technology company or any other company, is how to access data that other companies don't have, how to analyze and interpret that data to find interesting solutions and interesting answers to problems that we're trying to solve. I attended a conference, the Inside ETFs conference this past January, and Vanguard's global chief economist, Joe Davis, gave a presentation. And it's kind of an offshoot of what we're talking about now, but he basically had a group of researchers within Vanguard do this huge project called the idea multiplier. And the idea was that certain technologies are kind of compounding in the sense that, the internet wasn't a technology that just brought about web browsing. The internet was a technology that brought about 10 or 20 or 50 other different technologies out of that one technology. So his research group was kind of tasked with finding, what new technologies now are going to 10 and 20 and 50 years in the future spawn the most other technologies. How much will they compound? And again, it's a side note, but genomics, the idea of biotech and focusing on gene sequencing and gene level therapies was the absolute highest technology as far as potential being an idea multiplier, the number of technologies that would come off of that. But kind of as a side note, what he found during that research process was that the amount of data that they had to go through, that they had to collect and analyze and parse out, was just astronomical. And to bring it back to Oracle, I think that when you talk about the cloud, a lot of people think it's just a matter of storing data in a cloud, rather than on a floppy disk or on a hard drive. That it's just a matter of storing data in the cloud. But really, I think where the competitive advantage is going to be for companies is not just in the storage of data, but in the software that allows companies to access that data and to parse out that data and to analyze it and to maybe even use AI and machine learning to kind of come up with interesting interpretations of the data and what the data is actually telling them. So, if Oracle can, use its software to kind of create those solutions rather than just allowing it to be stored, then I think that they have a shot. But frankly, there's a couple companies that I have my eye on. One in particular that's much smaller than Oracle. It's a newer company. It's doing some more innovative things. It's actually kind of pioneered the storage as a service industry. So it's a stock that I've recommended in my Cycle 9 alert program as a short-term trade, but longer term, it's still kind of working to build up its growth rates. Actually, its growth rates are great, but it's working to kind of build up the quality of its business and its value. But I would kind of look to a newer competitor rather than Oracle as far as that software and data interface company.
And I'm kind of the same way. I think Oracle's a great company. Let's be clear here. All three of these companies are good companies. And we're just talking about whether, as an investor, you should be looking at these as potential buys for your portfolio. And the value is okay. Oracle's value is not overdone by industry standards, but it's tech, so the industry bar is actually pretty high in terms of valuation, and Oracle sits kind of in that just slightly below. It's got good return ons. It's a good long-term company, but I think it's in an extremely competitive space that an up-and-comer like Adam talked about can easily come in and have a nice moonshot to surpass Oracle. And it really just kind of depends on what Oracle's business plan is moving forward. And I don't think that's just too much that's unknown. I don't think we really know where it's going or what it's going to be doing. Is it going to be relying just on cloud infrastructure, or does it do kind of what Adam and Charles have talked about, and that is kind of branch out and use its software to as an additional as an add-on for its clients. So I'm kind of a pass right now on Oracle. Again, I think it's a good company. It's been a good company. It's got strong margins. It's got strong sales and income. It's cash on hand and debt, all very good. But again, nothing to really get me excited about it. TikTok, the least of which gets me excited about anything like that. And TikTok wouldn't get me excited about any company that bought it. So there's that. So just kind of recap, we discussed Adobe, trades on the Nasdaq as ADBE. All three of us were pretty high on Adobe. We like where it's going. We like its software as a service platform, and it's kind of in that space that no one's going to knock it off anytime soon. Cisco Systems trades on the Nasdaq, CSCO. I think we were all kind of a pass on Cisco. There's nothing that's there that says this stock is worth getting into right now. And then I think all three of us were a pass, but the sentiment I get is a pass. But again, it could be one of those where if you really wanted to get into it and wanted to use it as a long term buy and hold, maybe. But right now it's kind of a pass. That's Oracle Corp. On the New York Stock Exchange's ORCL. So that's going to wrap it up for this edition of the Bull and the Bear podcast. Glad you all have joined us. Again, just to kind of remind you, if you're listening to this on one of the podcast channels, you can check us out on YouTube. Go to youtube.com and do a search for Money and Markets. We've got a green logo. You'll be able to find us pretty simple. Go there, click subscribe, and go ahead and hit the bell. I think there's a little bell that pops up if I remember right. And that allows you to get alerted each and every time we have a video that comes out. Doing that will get you first access to those videos before we put them out on moneyandmarkets.com. Same way with the podcast. It goes the other way. You were going to say something, Adam?
Oh, yeah. I just want to jump in when you're done there. If we can talk about one thing that you talked about at the beginning there.
Yeah, sure. Go ahead.
Well, I just thought it was interesting for the listeners. You talked at the very opening of the show that the technology sector is up about 64% from the March bottom, and that was better than any other sector. I want to piggyback by that by saying that the consumer discretionary sector, so spending on things that we don't absolutely need, is right along there. It's like in second place with a 63% gain. And I think it's interesting because it shows that throughout this crisis, we're still buying things that we don't necessarily need, and we're still using technology. And then the other thing I wanted to kind of circle back to is that I did a quick scan of all the individual stocks within the technology sector ETF XLK. And I was curious if either one of you could guess which of those individual stocks is up the most from that March 23rd bottom.
Ooh, give us a hint.
Well, it doesn't operate in any of the spaces that we talked about today. It's actually a fintech company. That should be a good hint. Fintech.
I was going to say PayPal, but I don't think that's right.
You got it right. Yeah, you should go with your gut on that one. So, I mean,
Wow.
the point I wanted to make is that, within technology, financial technology, or what's called fintech, is really doing well right now. I found it interesting that within the technology ETF XLK, you have PayPal, which is kind of a more obvious fintech play, but you also have MasterCard and Visa. So, a lot of people would think of those as financial companies, but they're actually in the technology ETF.
I saw that, and I was actually half tempted to throw those out just as a point of conversation. But then I thought,
Yeah.
I don't know if that would really detract too much. But you bring up a good point about fintech and how much that's playing a role in overall technology stocks.
Yeah.
Well, it's
Absolutely.
also the point we've made in this show is it's hard to really, everything is tech now. Like even boring, styled old companies use tech. So tech is so ubiquitous now, like that the lines really are kind of hard to define.
Yeah, absolutely. So, I mean, fintech's definitely on a tear. PayPal's on a tear. I actually found a stock that I think is better than PayPal. PayPal is really expensive at this price. I mean, yes, it absolutely has a first mover status. It's basically built the industry. But I found a much smaller stock in my Green Zone Fortunes service. We can probably put a link to it in the show notes. But I found basically what I'm calling the frugal man's PayPal, because it trades at much, much lower valuations than PayPal. It's a much smaller company, so I think we can get better gains from it being a small cap stock. But it's basically doing exactly what PayPal is doing in some of the markets that PayPal isn't in right now. So definitely check that out. But yeah, give fintech a look, because it's not what you think of as traditional technology, but it's certainly pervasive.
Is frugal you're just a nice way of saying a poor man's PayPal?
Absolutely.
Very good. So yeah, check that out, and we will try to link to Adam's Green Zone Fortunes in the show notes as well. So make sure you check that out. Again, what I was saying beforehand, and that's a great point in terms of fintech and technology and how those two have started to not only merge, but fintech is now starting to take a stronger position within the tech industry as a whole, especially in stocks. So if you are listening to this if you're watching us on YouTube, you want to check us out on a podcast, do so. Apple Podcasts, Google Podcasts, iHeartRadio, Spotify. We're getting on Amazon soon. You can do that. Same thing applies with as YouTube. Just subscribe and get notified every time we put out a podcast. You'll get those podcasts before anyone else does, before we put them on our website at moneymarkets.com. So if you do have a comment, question, concern, maybe there's something you'd like us to look at specifically, email us, thebullandbear at moneymarkets.com. That's thebullandbear at moneymarkets.com. Stay tuned next week. We'll have coming up we've got our marijuana market update. If you missed that is also out. That is out. Our money markets week ahead will be out here as well. We'll have the Bull and the Bear next week, and make sure you check out moneymarkets.com for great financial insight. You'll see kind of what's on the minds of myself, Charles, and Adam, and kind of you'll be able to pick our brains without actually having to literally pick our brains. So it's kind of a cool way of getting that smart, safe investment information, so that you can make the best decisions possible for your investments and for your money. So for Money Markets Chief Investment Strategist Adam O'Dell and contributor Charles Sizemore, I'm Matt Clark. Until next time, everyone, safe trading.